At 9:42 a.m., Evergrande defaulted. The headlines called it historic. The markets called it inevitable. And somewhere in a basement office in suburban Chicago, a forgotten model blinked, red, precise, and 20 years ahead of the panic. Billions in Chinese property bonds vaporized in seconds. Construction sites froze mid-frame. Families who had paid for homes that didn't exist took to the streets. The world watched the second-largest economy crack at its foundation, and still called it a surprise. But it wasn't. Not to him. 2 decades earlier, he had built the model. Quietly. Obsessively. No hedge fund hired him for it. No government paid him for it. He didn't speak Mandarin. He'd never stepped foot in Beijing. But the numbers spoke loud enough. He tracked debt-to-asset ratios in Tier 1 cities, charted land sale dependencies, modeled feedback loops between GDP and steel demand. He saw the spiral before it began. Credit fuels construction. Construction fuels GDP. GDP justifies more credit. Until it doesn't. And in 2003, he ran the simulation forward. The result? Collapse. Not in 2004, not in 2010, but around 2023. Not from external war or political upheaval. From math, from gravity. No one listened. But now the equation was becoming reality. 1 default. Then 10. Then a whole skyline of unfinished dreams. His model hadn't predicted the names. It had predicted the shape. China had grown by building. But every boom, if overextended, becomes a blueprint for its own undoing. The quant was gone, but the formula remained. The day a forgotten equation caught up with a superpower. In 2003, China looked unstoppable. GDP was climbing at nearly 10% per year. Steel output doubled in a decade. Cement demand broke every record. Coastal cities expanded like time-lapse videos. Shenzhen, Shanghai, Guangzhou, all rising faster than the maps could track. Tower cranes filled the horizon. Roads materialized from farmland. Skyscrapers shot up before the elevators were installed. The world called it progress. Beijing called it rejuvenation. But underneath the applause was a deeper machinery. Real estate had become China's growth engine. Not a sector, the sector. Apartments weren't just homes, they were investments. A second income. A retirement plan. A store of value in a system with no trust in banks, no access to foreign assets, and no real yield. And the government encouraged it. Local officials were judged by GDP growth. Land sales were the lifeblood of local budgets. The formula was simple. Rezone land, sell it to a developer, count the revenue, and approve the next tower. Developers pre-sold apartments years in advance. Buyers lined up before construction began. Mortgages were handed out before floor plans were finalized. Steel demand rose. Copper imports surged. Concrete poured over rice fields. Foreign capital followed. Investment banks set up in Beijing. Global real estate funds flooded into China's urban centers. Ratings agencies approved billions in developer debt. No one asked where the demand ended. Everyone assumed it wouldn't. In 20 years, China built more housing than the US, Europe, and Japan combined. It was breathtaking and unsustainable. Because the moment growth depended on construction, construction could no longer stop. Even when demand weakened, building continued. Even when units sat empty, prices rose. Even when cracks appeared. On paper, the system worked, but someone else saw it differently, because someone in Illinois was watching. Shenzhen was a village in 1980. Rice paddies, fishing boats, and mud paths. By 2003, it was glass and steel. One of the most expensive cities on Earth per square meter. But it wasn't built by market demand. It was built by a machine. The machine was debt. Across China, cities competed not for citizens but for GDP rankings. Real estate offered instant results. Build a highway, GDP goes up. Build a stadium, GDP goes up. Build 10,000 apartments no one lives in, GDP explodes. Every province learned the trick. Every mayor learned the formula. Shenzhen perfected it. Land was not privately owned. It belonged to the state. But it could be leased at rising prices and sold again. Local governments auctioned the same land at escalating values to different developers. Revenues surged, budgets balanced, officials were promoted, developers borrowed to win the bids, then borrowed more to build, then borrowed again to pay off the last loan. Some sold apartments before breaking ground. Some sold them twice. Most relied on the illusion that prices could never fall. And in this system, everyone was complicit. Construction companies received payment in future revenue. Banks issued mortgages on unfinished units. Buyers invested not for shelter but appreciation. Apartments sat vacant, but their value climbed. Ghost cities weren't mistakes. They were inventory. Wealth parked in concrete. By 2003, real estate made up 30% of China's GDP. In cities like Shenzhen, it was closer to 50%. Land sales accounted for 40% of local government budgets. Real estate was no longer a part of the economy. It was the economy. And still, towers rose. Because no one wanted to ask the one question that could unravel it all. What happens when people stop buying? The answer was buried under scaffolding. But the warning signs were visible to anyone not dazzled by the skyline. The American Quant wasn't dazzled. He saw leverage. He saw debt. He saw growth that needed to accelerate just to stay afloat. And he'd seen it before, in Tokyo, in Las Vegas, in 2008. He didn't see a city. He saw a bubble. Shenzhen was the future, and that was the problem. He lived in Chicago, in the kind of apartment no one writes stories about. Second floor, dim desk lamp, books stacked like barricades. He wasn't rich. He wasn't famous. But he had something most people didn't: time. Time to read 700-page government white papers. Time to scrape construction data from provincial websites. Time to teach himself Mandarin. Not to speak it, but to read footnotes. He was a quant. Trained at MIT, fired from a hedge fund in 2001 for refusing to pitch a mortgage product he didn't believe in. Since then, he worked freelance, coding risk models for insurance firms, writing options algorithms for mid-tier funds, enough to pay rent, enough to stay invisible. But his obsession wasn't America. It was China. Not the headlines, not the politics, the numbers. He built a macroeconomic simulation model, a dynamic system of inputs: land sales, credit issuance, GDP targets, steel demand, migration data, cement pricing. Then feedback loops. Land sales fund local budgets, which pressure officials to sell more land, which encourages developers to borrow more, which inflates property values, which boosts GDP, which justifies more land sales. He called it recursive growth. The deeper he looked, the clearer the shape became. China's growth from 1998 to 2003 wasn't just impressive, it was algorithmic, a self-feeding machine. Credit became construction. Construction became GDP. GDP became political legitimacy. But the loop was unstable. His simulations showed a narrow exit path. The longer the property market grew without correction, the more painful the eventual reset. The deeper the debt dependence, the more likely the collapse would begin with developers, not banks. He saw 2023 as a critical point, 2 decades from the beginning of China's real estate liberalization. By then, he projected that debt service ratios would break above 200%, local government land revenues would stall, and unsold housing stock would pass 100 million units, a tipping point, masked by stimulus, but unmovable by policy. He wrote a 42-page report, sent it to funds, banks, a few research departments. No reply. He pitched it at a commodities forum in 2004. A junior analyst laughed. "China's going to build for 50 years, he said. They've got 1 billion people." He left quietly. He wasn't betting against China. He wasn't rooting for failure. But he had seen systems like this before. In Japan's bubble. In America's subprime markets. When construction becomes GDP, collapse is no longer a question of if, only when. He stored the model on a hard drive, printed a copy, updated it every quarter for the next 15 years, quietly, for no one. And then he disappeared from the industry. Some say he moved to Montana. Some say he coded for a biotech startup. No one knows. He never returned to finance, never gave another interview. But his model, buried in time, in footnotes, in forgotten folders, stayed alive. And when Evergrande collapsed, it matched his projection within 2 months. He wasn't a trader anymore. But the model wouldn't leave him alone. By 2005, it had evolved beyond simulation. It was tracking stress indicators in real time: unsold floor space, capital flight proxies, shadow financing spikes, commodity cycles, land auction anomalies. The lines moved like pressure gauges. He didn't need a news feed. The system told the story. And it told him one thing: the collapse would come, slowly, then suddenly. But knowing wasn't enough. He needed to act. So, he pitched it again. Not as a research paper, as a trade. The thesis was simple. China's real estate sector was a credit spiral masked as growth. Developers were over-leveraged. Local governments were addicted to land revenue. Buyers were buying not for shelter, but for yield. The system looked strong because it couldn't afford to look weak. The trade was more complex. Direct shorting was impossible. There were no CDS markets on Chinese developers in 2005, no liquid offshore proxies. So he got creative. He identified Hong Kong-listed subsidiaries of mainland developers, thinly traded, heavily reliant on mainland funding. He found U.S. firms with high China exposure and leveraged balance sheets. He looked at Australian mining stocks, tied to Chinese construction demand, and built layered shorts. He presented it to a boutique fund in Connecticut. The CIO nodded, then declined. China will bail them out, he said. He tried a macro hedge fund in London. They liked the math, but not the timing. Too early, they said. Too expensive to carry. He tried again in 2008 after the global crisis. But China unleashed a $586 billion stimulus. Property prices surged again. Analysts called it a new golden age. The trade looked foolish. He stopped pitching. But he didn't stop watching. He began building synthetic exposure himself, using options, swaps, and reverse ETFs. Not to profit, just to be positioned. His capital was small, but his conviction was complete. For 15 years he held variations of the trade, small, quiet, costly. Every time the bubble inflated, he nodded. Every time China cut rates, he took notes. Every time a developer overpromised and oversold, he updated the model. No media cared, no fund followed. They were too busy riding the boom. Because China wasn't just growing, it was growing the global economy. It consumed half the world's steel, copper, aluminum. It propped up emerging markets. It kept Western inflation low. It bought U.S. treasuries, German cars, African minerals. No one wanted to believe it could fail, and no one wanted to bet against it. It was career suicide to short China. Investors whispered about government retaliation, about capital controls, about patriotism, about politics. They called the trade unpatriotic. He called it inevitable. By 2020, he was long retired. The model still ran, now automated on a cloud server. The signals were blinking again, faster. Debt ratios breached warning thresholds. Pre-sales slowed. Land auctions failed. Offshore funding dried up. Then came Evergrande. In 2021, it defaulted on over $300 billion in liabilities, the largest property developer in China, and the most indebted in the world. The collapse began not with panic, but with silence. Projects halted. Protests flared. Bank withdrawals froze. Bondholders screamed into the void. And somewhere on a screen few had ever seen, the model updated. Status, match confirmed. He didn't celebrate. He didn't cash out. He simply printed the chart. The same one he first plotted in 2003. The trajectory hadn't changed. It had simply arrived. Collapse wasn't allowed in China, not openly, not yet. So when Evergrande's default rippled through the markets, Beijing didn't panic. It moved, swiftly, forcefully, quietly. First came the liquidity injections. The People's Bank of China pumped billions into the system through reverse repos, medium-term lending facilities, and targeted support. But they didn't call it a bailout. That word was dangerous. Instead, it was stabilization. Then came the guidance. State media insisted the risks were controllable. Regulators summoned bank CEOs. Local officials were told to ensure delivery of housing. The message was clear. Finish the apartments, keep the peace, delay the reckoning. But the cracks ran deeper. Developers, once flush with pre-sale cash, were now paralyzed. Households had paid for units that would never be built. Mortgage boycotts erupted. Thousands refused to pay for ghost apartments. Banks, once seen as untouchable, began to wobble. Regional lenders faced liquidity shortages. Rural branches quietly closed. And the government kept spending. Trillions of yuan in stimulus, new infrastructure projects, credit easing, rate cuts. State-owned enterprises ordered to absorb assets. It wasn't recovery, it was triage, because the model had flipped. For 20 years, China's economy ran on a property feedback loop. Land sales funded governments. Governments approved more construction. Developers borrowed more, built more, sold more, and inflated GDP with every crane. It worked until the demand died. Now, land auctions failed. Local government financing vehicles, LGFVs, began to default. Some couldn't pay workers, others couldn't pay interest. The fiscal backbone of China's provinces, land, was no longer reliable. And that's when the fear changed shape. This wasn't just a housing crisis. It was a governance crisis, a revenue crisis, a political risk. Because if growth couldn't come from real estate, where would it come from next? China's central planners had spent years trying to shift the model. Dual circulation, common prosperity, tech innovation. But the numbers always returned to real estate, the taxes, the jobs, the investments, the illusion. And illusions are hard to unwind. Beijing had tools, but each came with cost. Stimulus meant more debt. Bailouts meant moral hazard. Cracking down meant contagion. Doing nothing meant collapse. So they tried everything, all at once. Yet the market didn't recover. Consumer confidence fell. Youth unemployment soared. Private sector investment shrank. Global investors pulled money out. The more the government tried to patch the cracks, the more they exposed how deep they ran. And the Quant? He said nothing. He didn't need to. He had seen it all before, not just the fall, but the denial. Because in the end, China wasn't fighting the market. It was fighting time. Evergrande was the headline, the first domino. But it wasn't the only one. In the months after its default, a quiet cascade began. Fantasia missed payments. Kaisa stumbled. Sunak, Shimao, Greenland. Names once etched on golden towers, now written in red ink. Half the top 50 Chinese developers faced liquidity stress. Some collapsed entirely. Others defaulted offshore but survived domestically through shadow bailouts and asset seizures. Still, the buyers vanished. Apartments once sold out in minutes now lingered unsold for years. Ghost cities, already half empty, spread further inland. Families refused to buy homes that might never be finished. Even in Tier 1 cities like Shanghai and Beijing, transaction volumes dropped. The dream of perpetual price appreciation cracked. The core myth that real estate in China only went up had shattered. Construction sites froze mid-frame. Steel demand fell. Cement output dropped. Home prices declined for the first time in decades. In some cities, entire projects were abandoned. Concrete shells left to rot under monsoon rain. Stairwells exposed, cranes rusting. But the collapse wasn't just physical. It was financial. China's shadow banking system, the murky web of wealth management products, trust companies, and off-balance sheet lending, began to tremble. These entities had funneled trillions into property-linked products. Promises of 8%, 10%, even 12% annual returns to middle-class savers, all backed by nothing more than developer IOUs. When developers defaulted, the repayments stopped. Then came the protests. In Zhengzhou, hundreds surrounded bank branches. In Hunan, savers clashed with police. Elderly investors who had put their life savings into guaranteed wealth products discovered those guarantees were fiction. State media went silent. Social media posts vanished. But the damage spread, not in volume, but in confidence. China's financial system had never truly defaulted at scale. This was new territory. Trust, once the invisible engine of the entire model, began to dissolve. Local governments faced disaster. With land sales frozen, revenue collapsed. LGFVs, once tools of unstoppable growth, now struggled to refinance maturing debt. Some regions sold assets, others delayed wages. Infrastructure projects were canceled mid-bridge, and still, Beijing resisted the one move everyone expected, a full nationwide bailout. Instead, they used precision tools, easing mortgage rules here, injecting liquidity there. But the system was too large. Property made up nearly 30% of China's GDP, directly or indirectly. There was no clean exit. Each fix exposed another crack. Private firms were nationalized. Developers became wards of the state. Land auctions shifted from open bids to quiet transfers. The market became not a marketplace, but a management process. Controlled demolition. Meanwhile, international investors were trapped. Offshore bonds issued by Chinese developers fell to pennies on the dollar. Legal claims evaporated in jurisdictional fog. Courts stalled, regulators shrugged. Western funds that had once poured in were left holding paper with no market. It was a slow-motion implosion, not a bang, but a sequence of controlled failures, managed opacity, and unspoken write-offs. And in Chicago, the Quant's model ran, each node lighting up in sequence. He didn't have names, but he had parameters: liquidity thresholds, debt saturation curves, default clusters. For 20 years, he had modeled this fall, and now it was unfolding line by line. The real tragedy wasn't the fall. It was how long it took to admit it. For years, analysts spoke of soft landings, of rebalancing, of temporary headwinds. But the truth was simpler. China had overbuilt, overborrowed, and overpromised, and the bill had come due. Not just for developers, for an entire model of growth. The Quant never claimed credit. He never asked for recognition. But the accuracy of his projection circulated. A few journalists mentioned it. One podcast episode went viral. His original 2003 report was scanned, shared, quoted. He called it. He knew, but knowing and preventing are not the same. The machine had been too big, too profitable, too sacred to question, until it wasn't. And as tower after tower went dark, as construction jobs disappeared, as GDP targets were quietly lowered, the shape of the future came into focus, smaller, slower, more cautious. But the damage was already embedded. For 2 decades, China had grown by building. But the buildings outpaced the people, the debt outpaced the growth. And the belief, the faith that nothing would break, was the first thing to fall. The news cycle moved on. Markets recalibrated. Strategists rebranded their positions, but the Quant remained in the shadows, just as he had lived. He had no LinkedIn profile, no hedge fund track record, no speaking circuit, just one archived PDF circulated quietly among those who cared to look. A report dated 2003, a warning built not on ideology or emotion, but on math. He had gotten the timing right, the mechanism right. Even the thresholds, local government land revenues collapsing at 40%, developer debt exceeding 300% of equity. mortgage boycotts triggering a freeze in Tier 2 cities, all aligned with his projections. And yet, there was no reward. He didn't short Evergrande at the peak. He didn't profit from the defaults. His trades, cautious, indirect, paid little. He was right. But being right, quietly and too early, paid less than being wrong loudly and at scale. Podcasts started calling him the man who saw China's future. A few news sites ran short interviews. Analysts suddenly quoted his charts. Some investment banks retroactively cited his scenarios. They praised his foresight, now that it was safe. But none of them had listened when it could have mattered. And he didn't care anymore. He didn't need vindication. He had long accepted that markets reward narrative, not accuracy. That money flows toward confidence, not caution. That profits only become legends after the flood. He spent his days now in silence, updating the model sometimes, watching new cracks form, in countries that had learned nothing. Turkey, South Korea, Canada. The same ratios, the same leverage, the same hunger for returns built on sand. Because the system hadn't changed, it had globalized. China wasn't the exception. It was the mirror. A mirror that showed what happens when growth becomes dependent on illusion, and when no one has the courage to say stop. The irony? The Quant never hated China. He respected it, admired the ambition, the discipline, the vision. But ambition without restraint becomes momentum. And momentum, when untethered from fundamentals, becomes collapse. He once wrote in his notes, "The most dangerous markets are not the volatile ones. They are the silent ones, the ones that can't admit they're wrong." China had been silent for too long, and now it was paying for it. So was everyone else. For decades, China's rise had a formula. Build, borrow, sell, repeat. It worked. Until the repetition turned into saturation. Until the loans outpaced the lives moving in. Until the GDP growth became construction masquerading as progress. And when that broke, something deeper fractured with it. The very idea of the China model. Because this wasn't just about housing. It was about belief. The belief that a state could engineer prosperity indefinitely, that markets could be managed forever, that scale could substitute for sustainability. After the property implosion, that belief cracked. Young Chinese began rejecting home ownership, not out of rebellion, but realism. Why buy a future that won't exist, they asked. Developers vanished from billboards. Pre-sales collapsed. Confidence fell faster than prices. Local governments, starved of land sale revenue, cut services. Infrastructure slowed. Youth unemployment soared. In some regions, nearly 1 in 3 young adults couldn't find work. The promise, work hard, buy an apartment, rise with the country, was gone. And the world noticed. Global investors began reducing China exposure. Multinationals rerouted supply chains. Capital flowed elsewhere. To India, to Vietnam, to Mexico. The era of China as the factory of the world began to fade. Quietly, irrevocably. For the Chinese Communist Party, the crisis wasn't just financial, it was political. Stability had always been part of the deal. Rising incomes in exchange for obedience. But now the incomes were stalling. The growth was slowing. And the people, and especially the young, were drifting. Xi Jinping responded with a new slogan. Common prosperity. But slogans don't build confidence. And confidence, once lost, becomes the most expensive asset to replace. In policy rooms, the phrase new development model replaced high-speed growth. But no one could define what that meant. The model had died. The machine had broken, and the myth had melted. And yet there were no explosions, no Lehman moment, no grand collapse, just thousands of quiet defaults, stalled towers, and shrinking ambitions. It wasn't a financial crisis. It was an economic expiration. A moment when the fuel ran out and the engine kept spinning until silence. The Quant had seen this before. He once wrote, "When an empire depends on building to survive, it is already dead. It just hasn't stopped moving yet." Now the movement had stopped. There were no parades, no collapses shown on live television, just silence. China's property implosion didn't end in a crash. It ended in a long, slow exhale. $1 trillion erased from market value, millions of unfinished apartments, billions in unpaid bonds. And behind it all, a quiet admission, whispered, never spoken. The model was broken. The world kept moving. Wall Street found new trades, funds rotated out of Asia. But something fundamental had shifted, a realization spreading beneath the surface of capital. Even superpowers are ruled by numbers, because no matter how tightly a state controls the message, math does not obey. It compounds, it accelerates, it punishes delay and rewards foresight. And when it's ignored long enough, it no longer whispers, it shouts. The American Quant didn't win anything. He didn't want to. He only proved one thing, that truth doesn't need attention to be true. He had watched the rise, the denial, and the fall, quietly, without profit, without fame, but with clarity. Growth, when borrowed, is never free. And now the world must reckon with the lesson, not just in Beijing, but everywhere. Growth is built on credit, where housing becomes currency, where denial becomes doctrine. Because this wasn't a Chinese crisis. It was a warning. And not every system will get 20 years to prepare. Subscribe to Shadow Empires, where money became warfare.